Hello, today we will begin with the explanation of a new chapter. It is related to depreciation. Depreciation is the decrease in value of physical properties as time passes. So when I say depreciation, first of all, I have to know that the assets that I will say that they are depreciable or not has to be used for business. Okay, and this asset has to be used in order to generate some profit, and this asset has to be something that wears out, okay, or becomes obsolete. It's getting used up as you're using it over time, and it shouldn't be something with a life less than a year. I can't say that, for example, the pen I'm using, I'm gonna calculate its depreciation because it usually wears out with a period less than 1 year. So it has to be an asset used for more than 1 year, and it should be wearing out as we use it. So these are the characteristics of or the properties of assets that I'm gonna apply depreciation to it. Now, why are we studying depreciation? Depreciation is not a cash flow, but it affects the company's taxes. How so? Every year in accounting, they do their calculations and they calculate the book value of an asset. What is the book value? You see, let's say in our classroom, aren't we using the data show, the chairs, the board? These are the assets that I'm using in this business, okay? Now, if I bought them this year, they are brand new, and I have to calculate the taxes that I should pay this year. The taxes will be high because this is a brand new asset. What if I have been using those assets for 10 years? The book value of those assets has less or lower value. So can I apply taxes, high taxes on these assets? No, the taxes has to be low because the book value of the assets is being less each year I'm using this asset. Okay, so that's why, knowing this, I calculate the depreciation, how much am I losing of the value of the asset with the book value in order to pay less taxes. So if I want to calculate the book value, it is the cost basis, the original price of the asset minus accumulated depreciation. How much did I lose of the value of this asset? It is the book value of this year. Okay, this is the value of this asset as I will put it in my books for accounting. Now we have this method, which is the modified accelerated cost recovery system. It is the principal method for computing depreciation of properties in engineering projects. We have two types or two systems under this method. We have the general depreciation system, GDS, which is the main system that we're gonna apply, and we have the alternative depreciation system. We will not use this system. Now, using this method is easy. First of all, we have to determine the asset's recovery period. They have classified the assets according to their recovery period. Let's say furniture has a recovery period of 20 years, or this asset may live for a period longer than that. Some assets like electronics, computers, and electronics devices, they have a recovery period, let's say, of 5 to 7 years. So each asset is classified into a certain category regarding the recovery period. So your first step is determining this asset lies under which category, what will be its recovery period. Then the next step is going to this particular recovery period and see what is the period at which I want to get the depreciation for which year. So I'm interested in calculating the depreciation at a certain period. How do I get it? I will get the recovery rate from the table and I will multiply it by the book basis. Let's see, how do we get the recovery rates? This is a table that shows the recovery period. Okay, here we have a category of assets that have a recovery period of 3 years. Some are categorized to have a period of 5, 7, 10, 15, 20. So you just have to know your asset is under which category. If it's under the 7 years period, so I will be looking at this column. Now you'll notice that under each category, here let's say the 3 years, it's 3, so you will have 4 numbers. Okay, here it's 5, then you will have 6 numbers. Always we will have an extra value. Now what do they represent? What does these numbers represent? If you sum up the total of those numbers, you'll see that the total is 1, or the total is 100%. So at this year, at year 5, this asset will be totally depreciated. According to the books, it has no value anymore. Okay? Now here we agreed that this asset lies under the 3 years category. So you assume that this asset will live for 3 years. After 3 years, it will be totally depreciated. Why do I keep an extra year? Because sometimes, let's say this asset might live for 3 years, but sometimes people will continue to use it for an extra year, such as furniture. You say that it lies under the category of 15 years, but maybe you will continue to use it for 20 or 25 years. Okay? So we always get an extra year for usage, for depreciation. Okay? So these are known as the recovery period. Now, for 5 years, we said that you'll have 6 rates. Also here, the summation will be 1, equals to 1. Now, here, when I tell you that, I have an asset that has a recovery period of 5 years, and I want to calculate its depreciation at year 3. So what do? I look at the column related to 5 years, and at year 3, I just look at the intersection, okay? And this is the value that you get. What is this value? It is the value that I'm gonna use to calculate depreciation at year 3. So depreciation at year 3 will be this rate, okay? This recovery rate multiplied by the book value, the cost basis. Now, there's a very important thing to know is that there is an important point to know is that with respect to the GDS and ADS system, there is the half-year convention. Okay, what do you mean by that? This means that if you dispose an asset, let's say you have an asset that has a recovery rate or recovery period of 5 years. Okay, so it should live for 5 years, but we have an extra rate, so we have 6 rates for this assets. Okay, what if you decided to dispose it before the end of its useful life? It has a life of 5 years, so it has 6 rates, but you decided to dispose it at the 3rd year. Okay, so it's not fully depreciated. So in this case, I will have to multiply the value at year 3, the value of the recovery rate that I will get from the table, you'll have to multiply it by half. Because when you say that I'm gonna dispose a certain asset, did you dispose it at the beginning of the year, or at the end of the year, or at 3/4 of the year? So I don't know exactly when did you dispose it. So always we'll take it as a rule that if you dispose a certain asset before fully recovering its periods, this means that if you dispose it at period 3 and it has 6 recovery periods, so you didn't use the full recovery periods found in the table, you'll have to multiply the value that you got for this year by half. So this is a very important rule that you'll have to keep in mind. Let's look at this exercise to be able to understand the idea better. Here we have a firm that purchased and placed in service a new electronic component for $100,000. Okay, so this electronic component, it has the GDS 5 years recovery period. Okay, so I will have to tell you under which period does it lie. So here it lies under the 5 years. We need to determine the depreciation deduction in 4th year. Determine the book value at end of year 4 and the book value at end of year 5 if the component is disposed. Okay, so here I have to apply the rule that we have mentioned. So what is the first step? First of all, you'll have to look at the table. Okay, it lies here under 5 years. So these are the recovery rates that I'm gonna use. This is used for year 1, 2, 3, 4, and 5. This is if I decide to use it for an extra year. Now I was asked to calculate depreciation at year 4. Okay, we agreed that depreciation, this is depreciation, and K is the period. I want to calculate depreciation at year 4. So this is what I need to calculate, depreciation at year 4. It is the recovery rate for year 4 multiplied by the cost basis. The cost basis is the original cost, which is the $100,000. So what do I need to get? The rate at year 4. If you go back to the table, you will see that at year 4 it was 0.1152. So this is the rate that I'm gonna get it from the table. So what do? I apply the equation. Depreciation at year 4 is this rate that I got from the table times the cost basis. So the depreciation deduction of this asset at year 4 is 11,520. Okay, this is how, what's the value of depreciation. Now, what will be the book value at year 4? How much did I lose out of depreciation? So the book value is the cost basis, original cost, okay, minus accumulated depreciation. How much did I lose out of the value of this asset each year? So the book value 4 will be the cost basis, 100,000, minus a summation of the depreciation. We said that the depreciation of each year is the rate times the cost basis. So I can take the cost basis because it's going to be multiplied by all the rates of all the previous years. So this is the cost basis, and these are the rates for year 1, 2, 3, and 4. Those are the recovery rates that I got from the table for year 1, 2, 3, and 4 because I want to calculate the book value at year 4. So by books, the value of this asset, which had a cost basis of $100,000, its book value became $17,280. Okay? Now, what will be the book value? It's the same step. This is the cost basis minus accumulated depreciation, which is 100,000 times 0.2 plus 100 times 0.32 plus 100 times this rate and so on. So I want to accumulate the depreciation. Now, the only thing that's gonna differ between part B and part C is that here I was disposing the asset. So this was the rate for year 5. What did I do? I multiplied it by half because I was disposing it before the end of its useful life, because we still have an extra rate at year 6. So I didn't use all the rates in the table. So whenever I stop, I'm gonna multiply by half the last rate that I got from the table. So this is how we calculate the book value at different years, whether do I have disposal or not. This is how we solve the exercises. We agreed that according to the half-year convention, any asset that will be disposed at a certain year, we will only allow half the depreciation. So when I say this asset is disposed, okay, I dispose of this means that I'm getting rid of it, I stopped using it. So, and at any year when I do disposal, this means that I'm gonna get only half the depreciation. Now, when I dispose a certain asset, will I get a gain or a lose? When we dispose a certain asset, this might give us a gain or a lose. According to what? This is based on the market value of the asset. How much will I get at the market? What will be the sale price? And the current book value. So we have an equation for the gain or the loss at disposal. It is the market value at the same year, okay, minus the book value at the same year end. So when I get a gain, I will treat it as a normal income and I will apply taxes to it, okay? In this case, when I get an income, this means that the market value was greater than the book value. What if the asset was sold for an amount which was greater than the cost basis, the original price that you got from the first place? So this will give me a capital gain, okay? Now let's see an example here. we have this company who sold a piece of equipment during the current tax year for 78,600. So this is what? This is the market value, okay, because we sold it with this amount. This equipment had a cost basis of $190,000. This was the original purchasing price for this equipment, and I sold it for this amount. And the accumulated depreciation was this amount. You see, accumulated depreciation. Here in this exercise, I will not tell you to calculate the accumulated depreciation. It was already calculated for you. If it wasn't, this means that I will have to specify a certain year. Let's say get the accumulated depreciation for the past 3 years. So you'll have to go and get from the table related to the recovery period, you'll have to get the rates for the first 3 years, multiply each year by the cost basis, then add them together in order to get the accumulated depreciation. But here it's calculated. So based on this information, what is the gain or loss on disposal? So what do we have? We know that the market value is 78,600. Book value at the time of the sale, we have to calculate it. I know it is the cost basis minus accumulated depreciation. So the book value is 50,800. So what will be the gain following this rule? Market value minus book value. Okay, you see that you have a gain of $27,800. So you will treat it as an income and you will have to apply taxes on this value. Now, here, when I'm talking about taxes, okay, remember that we are still considering the project for investment, okay? And I will tell you, will you take this project for investment? Is it economically justified or not? Now, I used to do the previous calculations and decide which alternative is the best and so on without applying taxes. Now, in this lecture, we're gonna learn how to incorporate taxes and get a decision regarding the investment after paying the taxes. What if this was a very good investment, but once I applied the taxes and calculated the after-tax cash flow, I got the present worth and it was negative. So this means that after taxes, this is a very bad investment and I shouldn't do it. Okay, so this is the objective of studying depreciation, because I need to include it in my calculations regarding taxes and calculate the taxes and assess the project from the economical aspect after the taxes. Is it still a good investment or not? Now, if I want to calculate the after-tax cash flow, should I use the same MAR that I used before applying the taxes? No. We have to adjust the MAR. So we have to use this equation. The after-tax MAR, okay, can be calculated by multiplying the before-tax MAR times 1 minus effective tax, income tax rate, okay? So this is the before-tax MAR, okay, and this is the after-tax MAR. What do you expect? Which one is greater, the before-tax MAR or the after-tax MAR? Let's say here, before applying the taxes, I asked for a MAR of 10%, okay? And the present worth at the 10% was positive, so this was a good investment. After applying the taxes, can I still calculate the present worth at 10%? No, I should expect that the interest should be less. So I might tell you that the present worth using the after-tax MAR at, let's say, 7%, was positive, so this was a good investment. So you have to expect that the after-tax MAR should be less than the before-tax MAR. I'm gonna use this equation in order to calculate after-tax MAR. It is the before-tax MAR multiplied by 1 minus effective income tax rate, which will be given. The tax has to be given. Now, if I want to begin seeing how do we get the after-tax cash flow, okay? You have to understand that it's basically or generally before, it's the same as the before tax analysis, okay? We just add a new column for the after tax cash flow and we will treat it in the same way. However, we will make the analysis using the after tax MAR. Now, in order to calculate the after-tax cash flow, we have to know the following. We have to know the revenues. We have to know the expenses. We have to know the depreciation at each year. This is the income tax rate, okay? And this is the tax. So we have two things. We have income tax and we have the tax. First of all, we have to prepare the income tax, okay? It is my income at which I will apply the tax to it. Then the tax, I will say that the tax, let's say 10%. So this 10% is applied on this, on the income tax, okay? All these things have to be known in order to calculate the after-tax cash flow. How do we do it? First of all, in order to calculate, as I told you, the taxable income, the income at which I will apply the tax to it. Of course, the income without applying the tax is the revenues minus expenses. This is my income. But we agreed that we are calculating the depreciation and taking it into consideration to minimize the tax that I will pay. So if I want to calculate the income at which I'm going to apply the tax, it's going to be revenues at a certain year minus expenses minus the depreciation, so that the income will be ready for the tax to be applied to it. Okay, so this is the tax. Let's say the tax is 10%. Okay, so I will say 10% multiplied by this. Okay, revenues minus expenses minus depreciation. I will refer to this as income tax. Okay, this one is taxable income, income at which I will apply the tax. This one is the income tax. Then if I want to calculate the after-tax cash flow, it will be the before-tax cash flow plus the income tax that I have calculated. Okay, but in order to do that, my beginning step always is what? The before-tax cash flow, which is revenues minus expenses. Now, these calculations will be represented in a table. Okay, so all the questions of depreciation will come in a form of a table. You will have to fill all the numbers in this table. How do I start? First of all, you will have to begin with the years, periods. This project has a life of, let's say, 10 years. So you will have to fill the values from year 0 till year 10. Now, what do we do? My beginning step, as we said, is the before-tax cash flow. This is an ordinary cash flow diagram, the one that we usually draw in our exercises. What do we have at year 0? We have the initial investment. From year 1 till year n, what do we have? Ordinary income, whether it's positive or negative. So here, as if I'm getting the annuity. Didn't I used to say revenues less expenses? This is my annuity. I'm getting annual revenues minus annual expenses. I'm getting the resultant value. If it's positive, then this is something gonna be gained. It's gonna be positive. It's negative, then it's something paid. So here I will put the annuity that I have from year 1 till n, and at year n we will also have to include the market value. So this is what, if you look at it, it's a normal column, okay, as it's similar to the ones that we used to see in our exercises. What do we used to do with it? Get the present worth of this new cash flow diagram. If the present worth, I'm gonna get the present worth of this new cash flow diagram. If the present worth is positive, then this is a very good investment. Go for it. If not, then don't do it. Now, so this is my beginning step. Now, what's the next step? We add a new column. It's column B, related to depreciation deduction. Okay, I will get the depreciation for each period as we did in the previous examples. Okay, we have to specify the cost basis, which is usually the initial investment. Then multiply it by the rate at each year. Okay, from the table you will get the rate at year 1, 2, 3, and so on. Multiplied by the cost basis, you will create a new column for the depreciation deduction. The third column is the taxable income, your income at which you will apply the tax. It is what? It is revenues minus expenses, which is calculated here, minus the depreciation. Okay, so at each row, I'm gonna look at the value that I have at each row. I will say this value minus this value equals to this value. So you can see that this column here, I will refer to it as column C. It is what do I have at column A minus the value in column B. In this way, I will get my taxable income. At the last year, I should get the market value minus the book value to get a gain or loss. Because if I have a gain, then we agreed that this is an income and I will have to apply the tax to it. Here, I will apply the tax. You see, this is the income tax. What do I do with the income tax? This is column D. I will get whatever I get here from column C will be multiplied by the tax. Okay, so any value that I will get here at year 1, let's say I'll have to multiply it by minus tax. Why minus? Because you have to remember that this is something that you're gonna pay. This is the amount of tax that you will be paying. So that's why I multiplied by negative sign. So in this column, column D, it is column C times minus T. This is what? Your income tax. Now I know that this is the tax and this is the column of the cash flow before tax. How do I get the after tax cash flow? It is the amount here that I was earning before taxes minus the tax. Okay, but since here I already multiplied this whole column with a minus, so I can say that this column E is column A, the before tax cash flow, plus D, because it's already included a minus here. Okay, so in this column I will be getting what? After tax cash flow. After I get it, I will treat it as if it is a new cash flow diagram. I will have to calculate the after-tax MAR, okay, and calculate the present worth of this column at the after-tax MAR. If it's a positive value, then this is a very good investment after paying the taxes, so you'll have to go for it. If it's negative, then before the taxes, this was a good investment, but after paying the taxes, it's no longer a good investment. So this is the objective of this new chapter, to know whether this is still a good investment after paying the taxes. We will solve more exercises to understand the idea better. Thank you.